Welcome to the InterMarket analysis video update. This is a weekly video where we take a look at things outside of the S&P to see if we get any clues as to what's happening with the S&P. But we do take a look at the S&P as far as a valuation to see, is it expensive? Is it fairly priced? Is it inexpensive? Well, if you've watched these videos over the last actually couple of months, there really hasn't been any changes. All the asset classes that we follow are looking positive. The only thing that's looking really negative right now is the US dollar index, but we still want to keep an eye on this. I still do this video every week to look for subtle changes. And what we've been seeing a little bit going back to about the beginning of August is the market tending to get more defensive. Now, August is supposed to be a down month in a post-election year going back to 1950. Didn't end up that way this year. And September was supposed to be a down month. Didn't see it. And now we're working our way through the first part of October, which tends to be pretty good. But the second half, sometimes we can see some problems there. And now we have this government shutdown that we're dealing with. So we're not getting any economic report. Well, we're getting some, but we're not getting the real big, like the employment report that should have come out on Friday. It didn't come out. And we didn't get jobless claims or continuing claims. So until they work out all this government shutdown stuff, it, data is going to be a little bit lacking. Now, underneath that is still a pretty positive backdrop. The market is still anticipating that we're not going to go into a recession. And so earnings are looking pretty good for companies. They don't look threatened. They're not maybe as robust as they were before, but they're still going up, especially with the really big stocks, the mega caps. And we're not going into a recession. It looks like the Fed is going to come in and cut rates. The market's pretty much figured that in when they meet later on in October, that there'll be another 25 basis point cut or a quarter of a percent. And then there's going to be another meeting in December, and the market's pretty certain, but this can change, that they're going to cut rates again then. And it's not because the economy's falling apart. A week ago when I did this video, the concern that maybe the economy was getting a little too strong. Now, this past week, we had weaker than expected economic reports, the ones that we did receive, and the market seems a little bit more settled now. So the Fed coming in, cutting rates to tweak the economy without going into a recession, that's a pretty positive environment. But at some point, I mean, we've been going up since those April lows. We have not really fallen below the 20 period moving average more than just a day or so. And then we get right back above it. At some point, something's going to happen to tip things over and threaten this upward trend that we've been in. Now, when we look at sentiment, we're neutral. And we look at the individual investor survey, they're just barely positive. That, in a contrarian sense, could still suggest that there's more room to run to the upside. When the market really starts going up, you've got people that are freaking out because they're afraid that they're missing out on some gains, so they'll just jump into the market. Well, we haven't really seen that yet, and that's really what's been helping the market stay here at higher levels and setting all-time highs. We set an all-time high barely on Friday. We were up just a little bit. But you have a lot of people that don't believe the market should be going up, and that's probably why it's going up. So, okay. Now, this is being prepared for Monday, October 6th. All right, so first I'll go through valuation, and that applies to the S&P. Yeah, we've been overvalued for years now. That hasn't changed. We're also overvalued when we look back at historical earnings reports. We're overvalued when we look forward. And as I say over and over, I don't use valuation as a timing mechanism. You would miss out on some of the biggest gains the stock market's ever had if you use that approach. And valuation tends to not matter, but at some point it might. We're just not quite sure when that's going to happen. Then we look at growth versus value, bigger picture. Growth is still looking pretty strong, and that's what we want in a positive environment. A little bit more in the short term, that's where we see the market getting more defensive. But if we do decline, I'll just keep evaluating things. I put out videos every day, and we just say, okay, how are things looking now? Right now, it just looks like we're having a pullback if one even develops, and then we'll just evaluate it. If it's turning more negative, then we'll go with that. That's why I do the videos each day. Then we look at inflation, which doesn't seem to be a real concern to the markets right now. We look at other markets where this is also a bit hand in hand with inflation. We look at aluminum, corn, wheat, gas, oil, things like that to see if there's any inflationary pressures there. And then we look at the 11 sectors that make up the S&P. We look at the sector itself and then compare it to the S&P. We look at a number of different indexes outside of the S&P 500, and then some correlations between markets, and then some very long-term trends, mainly looking at monthly charts. And then at the very end, I have a positive and negative list. This is what has not changed for many weeks now. Everything's positive. The only thing that's negative is the dollar. Okay, valuation here. This is what we've been seeing for quite some time now. We have the S&P in black continuing to go up, setting new highs, and we're really extended above this red dashed line, which is a PE ratio of 20. Now, this chart is based on earnings reports that have already come out. And even by looking at things this way, we are overextended on a valuation basis. Also, we're overextended here. You go back and look at different times, different things that have happened. And there are times when we would come back down, but like during the great financial crisis, yeah, we went down with the S&P, but earnings were really going down then too. So even though both were going down, we were still overvalued from that aspect. And then we look at the Shiller PE ratio. This smooths out things over a 10-year period of time. Really high reading right now, coming in at 40.08. That's well above the median and mean between 16 and 17. And then here's another look at this. U.S. valuations are extreme, and 10-year returns from this starting point are usually poor, especially in real terms. Real means that you're counting inflation into the mix. Contrast this to when valuations are low. So this is a bit of a historical chart here, going all the way back into the 1800s, and then looking forward here. Now, okay, you can make a chart and say, all right, this is not looking very good, or hey, I'm okay with this. It's not looking all that bad. Then this is the forward-looking PE ratio, and we're well above 30 now with the mega cap 8. We're at 30.3. We're way above that 20 level. We're also way above 20 when we look at the S&P at 22.6. And we've been seeing small caps improving a little bit here, but they're still coming in when we look at the S&P 600. Now, there are times throughout the week when I show a valuation chart and it shows small caps actually being way overvalued. We're looking at the Russell 2000 when we see that kind of a reading. That's why I use the S&P 600, which is lined up with the S&P 500. The mid caps are the S&P 400, and they work better here with this 10, 15, 20 scale when we're looking at PE ratios, but they're more fairly priced here, with the mid caps coming in at 16.3, that's blue, and then the small caps in green coming in at 15.9. All right, man, real S&P 500 index and valuations, real inflation's counted in here. This is put up by Real Investment Advice. The blue line, that's the S&P 500, which has been recalculated to include inflation. And then the cyclically adjusted PE ratio over here, this is the black line, and they are going up. And then to try to get this exponential ratio here, we're way above this line, but the line is still going up. This also goes back into the 1800s. So yeah, we're overvalued, and you can take out 100 different charts, look at it 100 different ways, and it will still suggest that we are overvalued. All right, then we look at growth. This is just the growth index itself and an uptrend above both moving averages. Now, we're also doing okay with value. We're also above the moving averages, and we're in an uptrend here, actually setting a new high here with the pure value index. But where we get some insight is when we do ratios. And you can see bigger picture, growth is outperforming value. Now, we were starting to come down in August, but we never really saw a decline. Then the market got happy again, and we started to go up with this ratio. Now we're kind of rolling over a little bit, not turning negative, but just seeing a little bit of weakness here that could suggest the market is getting more defensive, which means getting ready to decline. But we've seen this before, and it didn't happen. And then we went back up with this ratio. Then I like to show some inverted charts. This is on the bottom is value to growth, where the top is growth to value. Just because the moving averages don't quite cross at the same time, we might see something in one chart that we miss in another chart. But this is showing how value is underperforming, but it has been bouncing back up lately. Then I look at long-term charts. I look at ETFs, indexes, a bunch of different ratios. This is showing how growth is outperforming value with these ETFs. We are pulling back a little bit, but still well above the 50-day moving average. The same thing, but inverted, showing how value is underperforming growth, but bouncing up just a little bit here. Then we look at some indexes here, S&P growth to value, doing good, bigger picture, but it has been pulling back. And this is value to growth, underperforming, but has been bouncing up a bit. Growth to value ETF, not showing an awful lot of strength, but not really showing an awful lot of weakness either, just at the high end of the rainbow. Then we do a value to growth measure here, showing how value is underperforming, bouncing back up just a little bit. Then we look at small cap growth to value. This has been a bit of a concern. Now we were doing good and we're just barely hanging on to an uptrend here, but then about when we hit May, we just started to go sideways with this ratio, and now we've been seeing it coming down. Even though small caps have seen more favor, and they've actually been doing a lot better. Now this is the S&P 600, not the Russell 2000. We're a little bit concerned here because unless we really jump above both of these moving averages really soon, like in the next trading day or two, we're probably going to see a death cross with this ratio. Now, mid caps haven't really been doing all that much, just going along sideways, but their growth to value ratio is looking a lot more positive. We're above both of the moving averages, and the upward trend is still intact. This is the one too that I pay most attention to. We've been doing really well. S&P growth to value. Then about August, we started to come down. We haven't fallen apart. We haven't turned negative, but we came down here, just been chopping sideways. Saw a little bit of a drop off here over the last few trading sessions. This would suggest that we might see a decline. And as long as we maintain the general integrity of this trend, it will just look like a pullback. Now, if we see this really starting to fall apart, we will change and adjust things accordingly. We can only go with what we're actually seeing right now. Then we keep an eye on inflation, and this is still giving us a little bit of problems, but we're not really seeing this confirmed in other charts. On top, you see a monthly chart of the CRB index, and it's hanging out right around the moving average, and the moving average is going up. That's long term. But then this was developed by Martin Pring. We have an inflation to deflation ratio. This has really been going up, and this is causing some concern, but we're not seeing it elsewhere in other things. So that's why I use a lot of different charts. I like to see confirmation across a number of different ways of looking at things, and we're not seeing that in other areas. And here's a daily chart of the CRB index, just chopping along sideways, not really seeing all that much of an upward move. We are in an uptrend here with the Baltic Dry Index. This is generally another inflation gauge, but we have been pulling back now down to the 50-day moving average. And then inflation expectations. This is what does the market think? And this is where I come out. You can watch YouTube videos, you can read articles, you can listen to podcasts, you can do whatever. And somebody could make a very convincing argument, especially if they're a perma bear, that we're just going to fall apart. Okay, fine. Well, I listen to that stuff, but I don't act upon it. I look at charts to say, what's the market telling us? And this is an ETF where we can track what are the inflation expectations of the market. Not really moving all that much. We were going up here as all this stimulus was coming into the economy, and then it was kind of chopping around a bit in 2022 when we were in the bear market. But in 2025, we did go down and we're back up and we're pretty much range bound overall. Then we look at inflation expectations and do a ratio with tips. This is still continuing to drop down a little bit, not really showing much in the way of inflationary concerns. Then commodities and break-evens. Break-evens have to do with looking at inflation down the road, and this is the 10-year, and then looking down further. It says the gap. Now, this is put out by Tava Costa. I'm down here at the bottom here. The gap between commodities and inflation has never been this wide, if you ask me, which we didn't, but I saw this chart anyway. Which one likely drives the other? I would unequivocally side with the yellow line, and this is going up, and that could end up being rather inflationary, but we're not seeing it in the market. So it's like, okay, we see this, we take it for what it is, and then we look for confirmation in other areas, which I'm really not seeing now, and that's called his real world inflation gauge. So since most goods worldwide are ultimately driven by commodity cost dynamics, prices go up, prices go down. Okay, then some other markets that we keep an eye on here. Aluminum, it has been coming back up, but it's still in a downtrend. It hasn't really moved over to an uptrend yet. Corn, great time of year to eat corn. You can get corn on the cob in the fall now. It has been coming back up, but still in an overall downtrend. Wheat, this still continues to be in a downtrend. Looking at fertilizer, it was going up for a while. Now it continues to go down. That's not necessarily a inflationary concern. Lumber is just kind of chopping around, falling below timber, and then it's rising back up. We're just about ready to generate a death cross here, but we've been here before. There's really not an awful lot of trend that's happening currently with lumber. Oil, which is going down. Now, as I usually say, I mainly follow this for geopolitical reasons. And there's talk about some kind of a peace deal in the Middle East. This doesn't necessarily impact the U.S., other than the U.S. being involved in the peace deal. But as far as oil, because Iran controls the Strait of Hormuz, and well, very little oil that comes to the US actually goes that way anymore. But this affects Russia, it affects China, it affects a lot of the Asian countries and so forth. But this going down is not necessarily inflationary. We're getting to the low 60s. We look at a correlation between oil, that's the red dashed line here, been going up a little bit lately, and then the 10-year yield, which has been dropping and then bounced back up here. And we can see there's a pretty strong correlation between the two, which means they're either going up or down together, usually at the same time. Gold to oil. Gold's been going up, oil's been going down, which is causing this ratio to go up. Diesel, it spiked up, came back down. It is going back up a little bit here, but it's not really breaking out to the upside. Here's gas, which we're seeing a death cross now here, and this is really dropping off and starting to go down. Heating oil, which is kind of hanging around its moving averages right now, it's just barely in an uptrend. And natural gas, which is starting to go back up, but is still in an overall downtrend. Copper, another barometer of the economy, seeing some improvement here. When we started getting those stronger than expected economic reports, copper liked that. It likes that the economy is actually showing some improvement. But even with the lack of reports that came out this week and weaker than expected ones, we're still seeing a pretty nice rise in copper overall. And then the copper to gold ratio has actually been going up here. Now, gold's been going up, but we have copper going back up. And so we're seeing this ratio bounce a little bit. But in the greater scheme of things, copper has been underperforming gold. Longer term, look at the same ratio. Going down overall with the copper to gold ratio, as we're seeing the 2-year yield in green and the 10-year yield in red generally starting to go back down. Gold just coming off of setting new all-time highs, silver setting new all-time highs. Why is that? Usually when precious metals really kick into gear, it's they say gold and precious metals are a hedge against insanity or craziness. Now, we're in a pretty crazy world right now, but the economy in the US seems to be doing okay. And the market's really ignoring a lot of these geopolitical things. Are the precious metals markets anticipating that the stock market is not anticipating? Eh, that's an open-ended question. I'm just throwing it out there. But when we see this gold to silver ratio going down, that means silver's outperforming gold, which it's been doing lately. And then we plot it against the US dollar index, and they're actually having a tendency to go in opposite directions currently. US dollar, this is where a lot of the strength has been coming from. Back as we started to head into the spring in 2025, when stocks really started to go down, the dollar was really going down too, and the stock market likes a weaker dollar. Well, on the weekly chart, if you watch the weekly video that I do, we're in a downtrend there, and this is a daily chart also showing that we are in a downtrend where the euro is outperforming the dollar. It's going up as the dollar's been going down. And then we put all three of the main currencies on here, just kind of chopping along sideways with the Japanese yen, where the euro's going up as the dollar's been going down. So then we look at the euro, it's still hanging out above its 50-period moving average. The Japanese yen just barely hanging on to an uptrend here, but it's pretty much been going sideways against the dollar. And the British pound actually also hanging out around its 50-period moving average. Then we switch over to stocks here, and this is a weighted to equal weighted look at the S&P 500. When this is going down, that means the equal weight is underperforming. Now, there's other charts that we look at that show that the equal weight is improving, and I'll show those here in just a moment. This is a stocks to commodities ratio. Now, if commodities were really going up like that inflation deflation ratio, we would probably see this ratio going down. So that's not a confirmation that we're seeing here. Stocks are outperforming commodities. This shows how commodities are underperforming stocks. And then we look at the NASDAQ 100 and the S&P 500. Now, the NASDAQ 100 did not set an all-time high on Friday. It was down slightly, but the S&P 500 did. They're both doing really well, but when this is going up, that means the NASDAQ 100 is outperforming the S&P 500. Where the NASDAQ 100 is growth, the S&P 500 is growth and value. It's more of a balanced index. S&P 100 pulling back a little right now, but still in the bigger picture, the big stocks that make up the S&P 500 are still outperforming. The Nasdaq is outperforming the S&P 500, and they're both doing really well by themselves. And we're still seeing where the Nasdaq 100 is underperforming the Nasdaq. And as I've been saying for the last couple of months now, you could take that as negative. It's like, oh my gosh, the big stocks are underperforming the rest of the broader Nasdaq composite. Okay, you could take that as negative. You could also take that as positive, saying, wait a minute here, the Nasdaq 100, that's a much broader index. And if it's outperforming the Nasdaq 100, isn't that a good thing? So take your pick, positive or negative slant there. Mega caps doing really well in an uptrend above both moving averages, and both moving average lines are going up. And here's the mega cap right here, and then compared on a ratio basis with the equal weight. Now, the mega caps have been outperforming, but see this little bit of a pullback here? Now, we pulled back as we worked our way through August, came down to the 50-period moving average, and then bounced up from that. If we still continue to see this falling, we'll say, okay, maybe the market's getting more defensive. And then the small caps, even though they've been more in favor lately, they like a lower interest rate environment. So if the Fed's coming in and cutting rates, small caps like that because they have to borrow so much money and it's lower interest rates. But when you look at the ratio between small caps and the S&P, they're still underperforming. The red line here, this shows the ratio between small caps and the S&P. The blue line is the S&P itself, underperforming here. And small caps continue to underperform the tech sector. Robotics and AI ETF doing pretty good here, but not back to the previous high set back in 2021, but still looking pretty solid here and doing a little bit better when we compare this robotics and AI ETF to the tech sector. It's been underperforming, but it's bouncing back up a little bit further into the rainbow currently. Excuse me. Now this, and I do all these videos take one, so I just kind of keep rolling no matter how much I cough or how many words I stumble over here. The semiconductors going up, we like that. We like this ratio to go up when we're more positive. Now the tech sector can be doing well, but it's when this ratio goes up, that means the semiconductors are doing even better, similar to what we saw at the beginning of 2024, and that was a more powerful up move. But it's not necessarily going to be that way all the time. As we worked our way through 2024, this ratio started to go down. And if you remember a year ago, we were still going up, setting new all-time highs with the S&P, and the Fed come in and cut rates 0.5% back in September in 2024, but this ratio still kept going down. So it's not imperative that this ratio go up. It's just more positive, and we can have a little bit more confidence when this ratio is actually going up. Dow Jones Composite Average, which is the Dow, the transports, and utilities. Now, the utilities are just not really going anywhere right now. No pun intended. The Dow's coming off of setting recent all-time highs. In fact, it set one on Friday. Utilities are back to setting all-time highs, but the transports are going nowhere. When you put the three of these together, this ratio is continuing to go up and starting to break out from the previous high. Low volatility ETF. This is what really holds up better when the market's going down. Now we're in an uptrend here, but for most of 2025, after we got through the spring gyration, we've just been chopping along sideways here. And when we do a ratio with the low volatility ETF with the S&P, really underperforming. If the market was getting ready to switch characteristics in the bigger picture, changing over to being defensive, this ratio would be going up. This is what we saw earlier in 2025 as the market was freaking out. Well, once we finally hit a bottom and started to go back up, this ratio started to go back down. And then all world, but you take out US stocks, looking pretty solid here, setting all-time highs, but you put the US back into the mix, not outperforming here. US stocks are still now not outperforming world stocks on a ratio basis. Energy is continuing to underperform the tech sector. Growth stocks are outperforming government bonds. This ratio is still looking pretty solid here. The tech sector is outperforming the 10-year yield. This shows how the 10-year yield is underperforming the tech sector. Discretionary is outperforming staples, rolling over a little bit here. Tesla got hit pretty hard. They came out with their earnings, I believe it was Thursday. The earnings report was good, but then they started to freak out about, well, we don't have this tax credit available anymore, and that might bite into our future sales. And Tesla was down over 5%. So we're seeing a bit of a rolling over with this ratio now. We'll see if that can resume going up. And this shows how staples are underperforming discretionary. Gold is out actually starting to outperform the S&P 500 again here because even though the S&P is going up, gold's been going up even more. And when that happens, this ratio goes up. And we've got the dollar going down and gold going up, so this ratio is just shooting off to the moon. Then we look at some other areas. Advanced decline line studies looking pretty good when we look at the NYSE, the S&P, but then we break it down and look at the mid caps and the small caps. We are improving, but we're still below the moving averages here. And we look at traditional Dow theory setting an all-time high, transports chopping along sideways, just starting to, I guess we didn't set a closing high here. We did on an intraday basis, but we're really close to another new all-time high with the utilities. And the weighted versus equal weighted version here is shown in a little different way, just over top of each other. They're pretty much going hand in hand right now. And when this is going up, this means the Dow is outperforming the transports because it's been going up as the transports have been going sideways. Here are the transports, just kind of more of a disappointing area currently. And the transports are also underperforming the S&P 500. And the correlation, it's usually pretty strong here, but we've been going up with the S&P. The transports have been going sideways. So we've seen this correlation actually getting back down more into the neutral area. Then we're setting an all-time high here with the S&P, just a little bit off of the all-time high with the NASDAQ, but they're pretty much confirming each other now. And we use this for new Dow theory. Instead of the Dow, we use the S&P. Instead of the transports, we use the NASDAQ. Then this breaks it out also. We are setting new highs now with the equal weight version of the S&P. That's good. That's showing more broad participation. Now, we're not seeing an awful lot of strength inside of the S&P, not a lot of weakness either, but not the strength that you usually would think we would be seeing inside of the S&P. But the fact that this is making an all-time high is positive. And then we look at the QQQ equal weight. This is also making an all-time high. FANG index kind of chopping along sideways. And when this is really going up because these are the big mega cap stocks, Facebook, Apple, Amazon, Netflix, Google, Nvidia, not really doing all that much over the last few trading sessions, but in the bigger picture, still looking positive. The Wilshire, a broad market measure here, closing way off of the high here, but it was still up. This is setting new all-time highs. We're also setting all-time highs with the total U.S. stock ETF. NYSE Composite setting all-time highs. ARC is doing better, but still has a long ways to go to get back to the high set back in early 2021. All stocks, U.S. and international stocks, still looking pretty solid here. High leverage loans looking pretty good. This is another barometer of the economy, still above its 50-day moving average, still going up. Emerging markets setting new all-time highs here and in an uptrend. The Japanese Nikkei starting to break out and really showing some improvement, setting new all-time highs. Bitcoin is back above its 50-day moving average, not quite back to its previous all-time high here, at least yet. Micro caps, really small stocks, they're breaking out and starting to make new all-time highs. Semiconductors, now they were down on Friday, but they did set a new all-time high here with the SMH semiconductor ETF. This is that same ETF, but just showing how we're above the rainbow here, just coming off of all-time highs. AI and tech ETF, this is looking a lot stronger than the robotics and AI ETF. It was down a little bit on Friday, but it did set a new all-time high on Thursday. Then we look at the S&P and the home builders ETF. Still a fairly strong correlated relationship between the top chart and the middle chart. We are dropping down a little bit here, so we'll keep an eye on this, but most of the time we tend to see a pretty high correlation. Then looking at another ratio, this is a monthly chart of US stocks to stocks in Europe, Australia, Asia, and the Far East. Bigger picture, the US is still outperforming. It's mainly been in 2025 where US stocks have been underperforming, and we're kind of flattening out here with the PPO longer term. Then this is also a longer term oscillator, kind of flattening out, but we have been in an uptrend in China. We're actually in a downtrend now, according to this, with emerging markets. And we're just starting to go into an uptrend in Japan, and we're in an uptrend in the US. Then bonds here. This is bonds based on price, where we were coming down as interest rates were going back up. Now this is starting to go up. That means that the 10-year yield is going down. Total bond ETF still in a solid uptrend, but a ways to go to get back to its all-time highs. This is the stock to bond monthly ratio. Now, once we finish September, we clicked over, and now what you're seeing calculated is the October. And this will change many times until we get through the month of October. But this is showing longer term how stocks are underperforming bonds. This is a daily chart showing how bonds are underperforming stocks and have been for quite some time. Praying World Bond Index, pretty choppy here. We are in an uptrend, but we're just coming into the high end of this range overall. And high yield corporate bonds, these are junk bonds, doing really well and just coming off of all-time highs. Investment grade bonds, more conservative. These are also in an uptrend. Corporate bonds, not quite back to an all-time high yet, but still in a pretty positive uptrend. And then we look at the stock to bond correlation, pretty strong trend. Stocks and bonds, at least lately, if one's going up, the other's going up. If one's going down, the other one's going down. That's what we mean by a high correlation. And this shows over a long period of time how we've been establishing a higher range for the yield when we look at the 10-year treasury. Junk bonds just down a little bit on Friday, but still coming off of recent all-time highs on Thursday. And junk bonds continue to outperform government bonds, pulling back a little bit. We're seeing this ratio kind of chopping sideways, but so far this is holding up above the 200-day moving average with this ratio. And then risky to conservative bonds, like junk bonds to government bonds here, going kind of sideways right now with this overall ratio. And we were coming down with the 10-year yield. Then the Fed come in and cut rates, and yields started to go back up. Go figure. But now, over the last few sessions, we've been seeing them come down, even though they did go up on Friday. And then this is a weekly chart. We're keeping an eye on this red line, which is Japan, land of the rising sun. So that's why it's red here, because this going up a year ago just freaked everybody out. Well, now it's going up, and nobody really seems to be noticing. And then we look at volatility of bonds to stocks. The VIX going up a little bit here, but it's still well below 20. And then we look at the MOVE index, which is on top. This is the volatility of bonds, which has been really coming down. And then we look at the correlation between the two, and they're neutral currently. And we look at 3 to 7 year bonds and compare them with the S&P. This going down just means the S&P is outperforming 3 to 7 year bonds. To say this another way, this chart is suggesting, according to the market, that we're not going to go into a recession. Then we look at the S&P to short-term bonds at the high end of the rainbow, setting new all-time highs. The S&P 1500 setting new all-time highs compared to 1 to 3 year Treasury bonds. Another broad market measure, SHHB, setting a new all-time high here compared to 3 to 7 year bonds. The tech sector setting a high compared to 3 to 7 year bonds. And stocks to the 10-year yield showing how stocks are outperforming. And a long-term look at the 30-year based on price, still having a hard time getting above the moving average. It has been declining for quite some time here. Then on the bottom, we look at a long-term bond to commodity ratio. This is actually starting to go up with this momentum oscillator. If that inflation deflation gauge was telling us anything, we would be seeing this actually going down instead of up. And we look at the sectors. Materials still just hanging out around its 50-day moving average, but still underperforming when compared to the S&P. Communication, a growth area, getting kind of hit a little bit here lately, not looking really bad, but pulling back recently. And coming back down to the 50-day moving average when we look at the ratio between communication and the S&P 500. If this continues to fall, now we started to do this back in July, but it didn't really lead to anything substantial. But we'll just keep an eye on this. Energy, still, it's in an uptrend, but just kind of chopping around here. But when we look at a ratio, it continues to underperform the S&P. Financials, still hanging out above its 50-day moving average and still underperforming. I've been showing this chart every day, pretty much going back to last spring. And we've been just watching this go down, 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 down. Now, I've actually added some additional charts because it's like, okay, This doesn't seem to be having that much of an impact on the market, even though we're seeing this ratio going down. So I've added some other charts and they're looking okay. And then we'll just have to see, all right, if those other charts fall apart and this ratio continues to fall apart, then that might be telling us something. And mainly what I'm talking about is called ARC-F. This is a financial tech ETF where it takes communication, tech, and growth together. And it's one of the ARC funds. Kathy Wood, if you're familiar with that. Industrials holding up fairly well above its 50-day moving average, but underperforming when we compare it to the S&P. But longer term, it's still in an uptrend, but it's been coming down since the latter part of July and really has yet to show much of a rebound. The tech sector, this is the big growth area, setting all-time highs and also looking pretty good when we compare it to the S&P. Staples, they're actually coming down now, where the other staples we were looking at was going more sideways. This is actually showing some weakness and underperforming when we compare it to the S&P, and that's more positive for the market. Staples are toilet paper and toothpaste. And real estate, they like that interest rates could be coming down. They've been hanging out above their 50-day moving average, but still really underperforming the S&P 500. Utilities breaking out and setting a new high here. They're still in a downtrend, but the ratio's really been coming back up. And we'll see if this continues or if it was more of just a short-term thing that's happening. And then this ratio has been coming down. In a more positive environment, we want this ratio to go up. That means the S&P is outperforming utilities, but lately this ratio has been declining. A little bit of a concern there. Healthcare. Well, there was some news announced about a pharmaceutical exchange type of thing, and the healthcare sector really liked that, and so it really gained an awful lot on the week. But it has a long ways to go to start to outperform the S&P 500. Discretionary still holding up fairly well. Did get knocked down by Tesla on Thursday and then saw some follow through weakness on Friday and kind of hanging out here a little bit below the moving averages and still in a downtrend when we look at the ratio to the S&P. Semiconductors just coming off of all-time highs. This is the Dow Jones Semiconductor Index set a new high on Thursday. The semi to Dow ratio above the blue line and advancing, even though it fell a little bit on Friday. Then we look at the intermarket analysis chart. Gold is up almost over 48% year to date. My goodness. Stocks are in second place. We have commodities and bonds pretty much the same. Oil is now back down to being negative year to date, and the dollar just has been hanging out down here at the bottom, negative year to date. Correlations. We look at the stocks to the dollar. They're actually having a tendency to go in opposite directions now. The stocks to oil also tending to go in opposite directions. Stocks to the 10-year yield also going in opposite directions. Tech sector to the 10-year yield also opposite directions. And stocks to the 2-year yield opposite directions. Interesting there. All right, and then these are some long-term charts. This is a monthly chart of the NYSE, looking really solid here, above the moving average, but we're still going down with the Copic curve. It would be even more positive if we could get back above the moving average and see the Copic curve start to advance. This is also another monthly chart of the NYSE where we continue to go up with the NYSE record high percent index. Even though we're seeing a little bit, never mind. Never mind. I thought something was happening here. We're still looking good here with the S&P monthly chart. I thought this was going down, but it's actually going up when we look at the longer term momentum. S&P looking good up here. Then we do a stock to commodity ratio. Yeah, it's turning up a little bit, but we would expect this to just continue to tank if commodities were really outperforming and showing us something inflationary. So we're not seeing confirmation there based on that inflation deflation chart. Then the S&P looking at global stocks, even though in 2025 US stocks have been underperforming, we're still above the moving average here, but it is picking up some weakness with the KST. Then here's all the positive things, blah 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 blah, and just when I get to the bottom here, you can just pause this and go, oh, all these things are positive. Then you look at the negative side. The only thing that's negative currently is the US dollar index. Thank you. I hope you found this helpful. I hope you have a great weekend, and I will talk to you in the next video.